Maximize these three levers, your real estate returns are going to be fucking massive. And on top of it being massive, you're levered up 5 to 1. So if your returns after all three of these added up together is, let's say, 20%, and you're levered up 5 to 1, then your returns are actually going to be 100%. What's up, everyone? Welcome to my video on why I invest in real estate. So I'm going to be breaking down the top 3 reasons of why I personally love investing in real estate. So let's get started. Number 1 is cheap debt. When we look at interest rates for different debt instruments, it's clear to see that real estate has the cheapest interest rate. Banks love to lend on real estate because it's a tangible asset and they feel like it's a very safe asset. And that's why when you buy a house, that mortgage amount, the interest on that mortgage is very low. Right now, if you look in the market, a lot of the big 5 banks are offering a 5-year fixed mortgage at less than 4% for a 25 to 30-year amortization. Now that's very cheap, and it's going to be very hard to find anyone who will loan you at less than 4% unless it's family or friends. But when you're talking about banks, 4% is as cheap, 4% or less is as cheap as it gets, right? So we'll compare it against line of credits, which are typically greater than 10% interest rates, credit cards, which are about 20% interest rate, student loans. See, a lot of us think student loans or education is an investment, right? We spend a lot of money on education. We hope to get a great job coming out of it, and that's going to be our return, right? And when we graduate with a shit ton of debt, and that debt is accumulating interest at greater than 5%. So why is it that education is considered an investment, right? Because you're trying to get a great return by finding a great job. But a lot of people think that, hey, real estate's very dangerous. I don't want anything to do with it. I don't want to invest in real estate. When the bank loans at interest rates less than what you can get on a student loan, right? You can get interest rates less than 4% on real estate. So if you're able to earn anything more than 4% on your investment, your return is going to be, let's say you earn 10%. It's going to be 10% minus 4%. That's going to be 6%. Your return is going to be 6%. That spread between your return on the asset minus the cost of debt, right? So anyways, I was getting very excited. But again, a lot of people think that student loans or education is an investment, but they don't see real estate as a great investment tool as well. And lastly, margin trading, which you can find that people lever up when they trade stocks. And that interest rate is greater than 7% for the most part. So you're expected to earn more than 7% when trading in stocks. And if you earn 5%, your cost of debt is, let's say, 7%, right? Your spread is negative 2%, so you're losing money when margin trading. And if you're levered up 2 to 1, then that's gonna multiply to 4%. Again, real estate has very cheap debt, so I encourage you guys to take advantage of that. And that leads to reason number 2, which is leverage. And leverage, for those of you guys who don't know, is basically just debt. Very messy writing, my apologies. Leverage, debt. Shout out to Michael Rosehart, by the way. His link to the channel is going to be down below. He did a very comprehensive breakdown on leverage and how it can help fuel the returns on real estate investing. Basically, the premise of leverage in real estate investing is that you're buying a $100,000 house, right? This is going to be an investment property. And as a result, the bank says you got to put 20% down. 20% of $100,000. That's going to be that's going to be 20 grand, right? So you're putting 20 grand down as down payment. Who's going to pay that other 80 grand for this house? That's going to be the bank. See, the bank's going to loan 80% loan to value. So the value of the house is 100K. The loan that they're going to give is 80K. That's an 80% loan to value, or LTV as a lot of people call it. Now, how is this powerful? Your buying power is basically $5 for every $1 you spend, right? You're levered up 5 to 1. So basically, for every $1 you put in down payment, the bank is gonna give you $4, right? So your buying power is actually $5. And this is an extremely powerful tool, which we'll show just now. So let's go off the same example. You bought a house for $100,000. Let's assume the case where, hey, I don't want leverage, I don't want anything to do with that, right? So what's my return gonna be? In other words, that means that I'm unleveraged, so I don't have any debt. So my unleveraged return, that's basically gonna be my net operating income, which is divided by my purchase price. So your unleveraged return is going to be your net operating income divided by the purchase price, right? So your net operating income in this case is going to be all your revenues, all your rental income, minus all the expenses. There's going to be no mortgage payment because, again, we're unlevered. We're assuming that we're not taking any debt. We're buying this entire property in hard cash. So the purchase price of this property is $100,000. We're buying this property at $100,000 in cash. Let's assume that the net operating income is going to be $12K a year. So $12K a year. Your return is going to be 12 divided by 100. That's going to be, that's going to be 12%. Your return unlevered is 12%. Now, sorry guys, there's not enough space, so I added a bit more space to write down the math down here. Quick recap, our unleveraged return is 12%. So that assumes we have no mortgage payments, right? Now let's calculate our returns if we were to assume debt, and that's cheap debt. Right now, I could go out to RBC, to BMO, to Scotiabank, and probably qualify for a 3.5% interest on a 5-year term for a 25-year amortization period, right? So essentially, the point I'm trying to get across is the cost of debt is 3.64%. My apologies, guys. For some reason, I ended up losing the footage for this bit. Still have the footage for the beginning and the end, so I'm just going to quickly breeze through this quick analysis where I left off. What we said was that our unlevered returns are 12%, and we want to calculate what our levered returns is, which means that we are assuming debt. How does that impact our returns? Well, 12% is the return assuming no debt, and the cost of debt is going to be 3.5%. So if you go on any of the banks and look at 5-year fixed term mortgage, it should be around 3.5, maybe a little bit more, maybe a little bit less. But our levered return is going to be 12%, what it is unlevered, minus the cost of debt, 3.5%. That cost of debt, we're going to multiply it by 80%, because we are only assuming 80% loan to value, as we talked about earlier. On a 100K house, we are only borrowing 80K, 28K is going to be on down payment. So 12% minus 3.5% times 80%. So our return is going to be 9.2% after debt. Wait a minute, Austin. How is it that our unlevered return is 12% and when we take out debt, our return is now 9.2%? I thought leverage was a key driver in real estate returns. I'm not done yet. So remember when I talked about when we borrow money, we borrow at 80% LTV or we borrow at 5-to-1. So this 9.2%, that 9.2%, we're going to multiply that by 5 because we're borrowing 5-to-1. Our return is actually 46%. And that's pretty crazy, right? This return is only considering cash flow. It doesn't consider appreciation. If we were to replicate this math with appreciation, it'll be the same impact, right? So again, just to quickly revise, our unlevered return is 12%, right? So 12% minus our cost of debt, 3.5%. But our cost of debt, we have to multiply that by 80% because we're borrowing at 80% loan to value. And that gives us a return of 9.2%. but we lever up 5 to 1, so 9.2% times 5 is 46%. So our total return is 46%, not including appreciation or anything else, just on a cash flow basis. Let's say the market appreciates by 2%. Your return is not going to be your $20,000 initial investment appreciating by 2%, which is going to give you 20.4K, right? So your profit's $400. It doesn't work like that, right? It works on the entire home amount, right? So basically, if your home appreciates by 2%, your initial investment's only $20,000, but that 2% increase is gonna be on the home value. So $100,000 times a 2% increase, that's gonna be 102K, right? So your actual return is going to be, so you have $2,000 in profit from appreciation divided by your $20,000 initial investment. So that is going to be actually a 10% return. You're levered up 5 to 1. So if the market appreciates by 2%, you're actually getting a return of 10%. So the power of leverage works both ways, in appreciation and in cash flow as well. But let me preface this by saying the reason why I don't solely bank on it is, although appreciation is a powerful tool that we see over here, if you're not cash flowing, leverage works the opposite way as well. Leverage giveth and leverage taketh. So let's show an example on cash flow and why it's extremely important, especially when you're dealing with leverage, right? So the unlevered cash flow in these Toronto markets are typically around 3 to 4%. These unlevered cash flows are also referred to as cap rates, which I'm going to explain later in another video. But anyways, your unlevered cash flow is 3 to 4% in Toronto, right? Your cost of debt, let's say, so 3% is where you'll find most of the downtown condos, about a 3% cap rate. Your cost of debt is 3.64%, right? So you're losing multiplied by 0.8. So you're losing approximately 1%, right? But you're levered up 5 to 1. So that negative 1% is going to be amplified by 5 because you're taking on debt, right? So your return is actually going to be negative 5%, right? So can you sustain a negative 5% return for every year until the market appreciates? Maybe so, maybe not. Last reason, final reason, is returns. So I talked a little about that over here and taking advantage of leverage to multiply your returns, but in real estate, you can focus on 3 main drivers of returns. The first one is appreciation. When I invest, I try my best to find a property where I can force appreciation. And what that means is that real estate is not a perfect market. Information does not flow properly in real estate, right? So you can find undervalued properties. For example, let's say you go into a house that's all fucked up and run down, right? You're not gonna pay money to buy that house. Or if you pay money, it's gonna be so far below market value because you don't want to deal with all that shit, right? But let's say that an investor like myself goes in that house and sees the potential of renovating it, right? The renovations will only cost me $20,000, right? But that gives me a brand new house, and the market value goes up by more than $20,000. It might go up by $50,000. That's essentially the premise of forced appreciation. So real estate is not a perfect market. Information is not perfect. And that means that there's a lot of arbitrage opportunities in real estate. So you can find these rundown, undervalued properties, renovate it up, and for the most part, the cost of the renovation will be less than the market value increase in that property. So that's what I mean by forced appreciation. Great arbitrage opportunity in real estate, not a perfect market. And then second is natural appreciation. We know what natural appreciation is. It's essentially just the appreciation in the market. So for example, if you're investing in Windsor, from last February to this February, home prices appreciated by 20%. That market is extremely hot, right? So if you're able to forced appreciation, and on top of that, take advantage of natural appreciation. You can really take advantage of the overall appreciation returns. Secondly, we all know this, and this is why a lot of us invest in real estate, is equity pay down. So you're having your tenants in there paying rent every single month, and that rent should also cover your mortgage payments. So you're not paying for that house yourself, your tenant's actually paying for that property for you, and that's the premise of equity pay down. So with equity pay down and appreciation together, that's a very powerful tool. As time goes on, you see this is the house. The value of the house is gonna go up over the long term, right? And as you pay down your mortgage over the long term, you're paying more in principal and less in interest. So that means that over time, you're paying down more of your principal. So as the market appreciates and you're paying down more in principal, your return is gonna be that spread, right? So real estate's very attractive because of equity pay down, which goes hand in hand with appreciation. And lastly, if you guys haven't watched my first video explaining the importance of cash flow, I'm not going to go into depth in it now, but the last lever of real estate returns is your cash flow. So when you rent the property out, you minus your mortgage expenses, you minus all these other expenses of utilities, a property manager, so on and so forth. How much net cash are you bringing home every single month, right? So when you are able to maximize your appreciation by forcing appreciation in undervalued properties, invest in places that have the potential to appreciate in the long term because of strong economic fundamentals, great population growth, great jobs, or a very, very reputable university or school. You can take advantage of appreciation. When you're able to rent this property out, the tenant is paying down the mortgage payment for you. So you take advantage of equity pay down. And lastly, the cherry on top of everything, if you're able to cash flow as well, then basically you can maximize all of these three levers, right? When you maximize these three levers, your real estate returns are gonna be fucking massive. And on top of it being massive, you're levered up 5 to 1. So if your returns after all three of these added up together is, let's say, 20%, and you're levered up 5 to 1, then your returns are actually going to be 100%. And this is why I feel like real estate is a very, very, very attractive investment opportunity if you're doing real estate right. See, a lot of people might do it incorrectly or invest not with the perfect strategy. But if you're able to invest properly, you can really, really maximize your return using very cheap debt, using leverage, and also using these three pillars or levers into what constitutes returns to really maximize the amount of money that you make out of your investment property. Anyways, that concludes the video for today. Thank you guys so much for watching. If you have any questions, please comment below. Please like the video. Please subscribe to the channel. And you can find me at AustinYay6 on Instagram if you guys want to follow me on my journey. Thank you so much.